Firstly, I'd like to thank everyone today for joining today's webinar on avoiding revenue roadblocks. Today, you're among 100 CFOs, operating partners, and investors who've logged in from 6 different time zones across 3 continents. Early this month, Camino's team released our second edition of the Global Report, which has been read by industry leaders across 14 different countries. And we received amazing feedback on Gary's article on successful SaaS scaling, which has given us the scope for today. I hope everyone finds this session useful. And let's kick things off with introductions. So firstly, I'm Oliver. I lead Camino Search's CFO practice, and Camino Search focuses on placing transformational talent into technology businesses across Europe and North America. Gary, can you please introduce yourself to the audience?
Yeah, very good, Oliver. Thanks so much, and it's great to be with you today. So just in terms of background, I'll go way back. I was born and raised in Canada. I've worked most recently for a number of software companies. So really the second half of my career have been with software companies, all SaaS software companies. Currently, I'm the CFO of a company called Defi Solutions. We are a software provider in the automotive vertical. So for automotive financing, we sell primarily to credit unions, banks, and what we call captives. So if you think of VW Financial or GM Financial, they are customers of ours. And we have originating software as well as servicing software. So help those entities both originate and service their loans and leases.
Brilliant. Well, I appreciate you logging in all the way from Austin, Texas. So thank you so much. I'm really excited to get stuck into this. Dan, it'd be great if you could introduce yourself to the audience as well.
Of course. Thanks for having me, Oliver. My name is Dan Thompson. I'm co-founder and CEO of Kluster. I'm a theoretical physics graduate. Had experience as a data engineer at a fintech company before spending most of my career as an actuarial consultant in the Lloyd's of London reinsurance market. And I would go into businesses and build large configurable forecasting models for unpredictable events, natural disasters, hurricanes, maritime and aviation disasters, and things like that, used both by financial institutions, but also the Bank of England, the White House, and other entities like that. I was very fortunate to be discussing this with a very successful sales leader, and we ended up partnering to bring this kind of forecasting expertise to private equity-backed B2B companies. So we started Kluster, which is a forecasting company, forecasting solution.
Brilliant. And some really cool data and insights to come throughout the conversation, which I'm really excited about. So thank you so much for the intros, and let's jump into everything. The first question I have to pose for Gary. So what would your playbook be if you were a new CFO joining a PE-backed company and you were looking to assess the efficacy of revenue forecasting?
Sure, Oliver, like I think a lot of finance people, I have pretty much an orientation around the income statement and P&L. And so start at the top, start looking at sales, and even over and above where you start with sales, look at bookings. So how does that flow through the system? What systems, what processes are used to manage the pipeline of opportunities that you have as a business, and then go from there. I think when I look at entering a PE company and looking at revenue forecasting, which I've done a number of times right now during my career, and including right now. I joined Defi Solutions just 3 months ago, so I'm going through that process right now. I think one of the key, if not the key relationship, is with the CRO, so the Chief Revenue Officer, who typically has the responsibility for sales and often for marketing as well, and really building that relationship with them. You know, over my experience, I've had a chance and an opportunity really to work with some outstanding CROs, ones that you can really partner with. And I remember I learned very early in my career, when I was just a young financial analyst at a big company, a mentor sort of took me aside, because finance people, especially when you're fairly junior, really focused on expenses and controlling costs, especially this company, because we were essentially a manufacturing company. And the lesson he taught me said, and the way he wanted me to think was, it's very difficult to have a bottom line unless you have a top line. And so that was his message to me around the importance of obviously understanding revenue, how your company generates revenue and manages it as well. And so that's carried me through my career, and that relationship with the CRO is very, very important. Because I've been fortunate, at least in the companies that I've worked with, we've had far more opportunities that we could go and chase than we could possibly handle. And they would not all necessarily be good matches for us as a company. And the best CROs or sales directors or regional managers, however you're structured as a sales team, they can really focus the organization and focus the sales team on what's worth spending time on, and probably more importantly, what's not worth spending time on. And I don't have that talent. I don't have that sense of, this is a deal, we need to put our resources on it and chase it. It's because it's a little bit of art. And I don't have that, but a good CRO does, in terms of directing their sales team, looking at the pipeline, all the opportunities. That's one we got to put our resources on. That one, don't spend any time on. That's not going to happen this quarter. Maybe it's never going to happen. So don't spend any time on that. And so that relationship between the CFO and CRO is very, very important from my perspective. And from where I sit, understanding what's in the forecast, the judgment that's gone into it, and then also, arriving at what is the most accurate forecast we have for the quarter, for the half, or perhaps for the year.
Brilliant. Thank you for that, Gary. And just to feed off the back of that question, when you come in and I suppose the forecasts aren't where they want to be, and you're trying to foster a relationship collaboration between finance and the revenue generating element of the business. But what are your kind of like, it may be simple, like weekly meetings or whatever it is, but what are the foundations you initially look to put in place to kind of foster that relationship initially to then build from?
Yeah, I think that routine, that operating rhythm of a weekly forecast has worked best for me in my experience. And it again depends on the business and sort of the characteristics of it. But a weekly forecast meeting, particularly on bookings, looking at the funnel of opportunities and hearing from not just the CRO, but the CRO's direct reports or even the salespeople on each of those deals. Where do they stand? What progress have they made in the last week? Is it moving forward? Are they blocked? Are they stuck somewhere? Can we help them? All of that discussion adds a lot of quality to the forecast. It's more than just a set of numbers now. It is a set of numbers and deals that the organization as a group makes a judgment on in terms of what they're willing to commit to the board in the quarterly forecasts, et cetera. And so I found that is just that rhythm. In my last company was every Friday. Another company was every Tuesday. Whatever day it is, everybody knows that's the day we go through the forecast. From a systems point of view, we've the companies I've worked for in the last 15 years have all been Salesforce. I think Salesforce might have a monopoly or certainly a big market share in terms of managing the funnel of opportunities. And so that really has become the standard. And I would say most sales teams and go-to-market teams are very familiar, very fluent, perhaps even expert at using the system. And so that's been really the system of record for all the companies that I've worked for in the last, as I mentioned, 15 years, as the system of record for opportunities and where that houses and where all that data is housed.
Brilliant. And Dan, I'm sure you've seen many cases of this where there's a new CFO coming into a business, revenue forecasting isn't where it want to be. Typically, what are the data points you're seeing in that scenario through the system?
Yeah, absolutely. So on average in the market, it's pretty dire, I'm afraid, but which I guess is good news if someone's joining your company. But around 93% of companies don't have confidence in their forecast until around 2 weeks or less before the end of the quarter. So that's kind of a 95% accuracy or above, and over 60% are missing quota. Now, that very material drop in quota attainment started happening kind of 18-24 months ago, and there are early signs that it's increasing across the market, but it's pretty slow. But essentially, that's the benchmark of what's happening in the market. I'd say in terms of joining the company, you'd want to be reviewing the accuracy, to Gary's point, not just across all the revenue lines, but all the way down to managers and teams and even the reps, and then from there build up a roadmap of where you want to get to over the next year and deploy it accordingly. I think to Gary's point on running the weekly meetings, not only does that drive much more accurate forecasts, but as mentioned, it really drives sales execution as well. Because if you're looking at the biggest levers of what's pushing your forecast up or down, those are then by definition the things you need to act upon within the sales organization to drive that number.
Brilliant. It's interesting when you get into the data, isn't it? That like that hearts and minds piece initially for the CFO is so fundamental, being able to come in, build great relationships cross-functionally and get things on track. So yeah, brilliant insights. So thank you for that. When we get past the initial kind of joining of the business, you've built the relationships, you've got those weekly meetings in place, and we get actually into the detail of the contracts themselves. I've got a few different points that I want to run through, so I'm just going to run through 3 different questions, and I'd love it if Gary, you can give us your perspective, and Dan some of the data points around it. So what do you do between contract signature and revenue recognition? And then what are the assumptions between deal closing and revenue recognition? And finally, what are the rules of thumb for new business pipelines and how it converts to revenue?
Maybe I'll take a shot at the second question first, just in terms of the assumptions between deal closing and revenue recognition. Ideally, there'd be none. And that would tell me, and again, I've worked in different companies. Some have been very good at this, others not so good. But ideally, and where it was done well, was as deals are being formulated by the salespeople, and again, it's a little bit of that relationship that you have with the sales organization, the salesperson fairly early in the process brings in a finance or accounting person. Here's how I'm thinking of structuring the deal. How would you recognize this from a revenue rec perspective? Obviously, they're trying to maximize their commissions, and so they want the rev rec in a way that is favorable to them. I think most companies, certainly PE-backed companies, all have this concept of a deal desk, that it comes for a larger deal or one that has a particularly large discount in it, comes up for formal review and approval. Typically the CEO, the CRO, CFO, maybe there might be operations or R&D people involved as well. And at that point, before any kind of proposal goes into the customer, the finance organization has a look at that contract and usually sets a ruling. This is how we're going to recognize the revenue if the customer accepts the contract as is. So from a rev rec perspective, the assumptions really shouldn't change, certainly for revenue recognition, between when you close the deal, when you sign it, and when it actually gets booked and you start invoicing it and recognizing the revenue. I think the other part where I've seen this done particularly well, talking a little bit between contract signature and revenue recognition, is operationally making sure implementation and the operations team. And one of my companies, which was a little bit more transaction oriented, had a lot of small deals, not these big ones that we'd have a deal desk, but just a lot of add-ons, transactions, cross sells, upsells, all of those smaller types of deals. We had what we called a dispatch function. So it was a function that kind of gathered all the information for invoicing, who's going to turn the software on, who's going to make sure that this integration between the system and their system is working, and having that function operationally between signature and then typically when it goes into service or goes live, that function organizes all of the operations, especially if there's not much implementation, just making sure that everything's in place. So when the service period starts, basically flick a switch. And I know it's much more difficult than that, but flick a switch, the service is on, you start recognizing revenue. I think those are a couple of the important actions that happen between contract and rev rec. And as I mentioned, from a finance perspective, having the rev rec as early in the process, so the sales guys know, if I do this deal, this is how the revenue is going to recognize, this is what I'm going to get paid. That helps so much. And it's easier said than done, of course, but it does make a big difference.
Brilliant. Thank you, Gary. And Dan, what do you typically see at this stage?
Yeah, so I think there's a more overarching theme that impacts both the sales bookings forecasting and the rev rec and then the revenue forecasting, and it's essentially that in the past 24 months as the market has shifted, things have really slowed down in a literal sense. In the sales cycles, in the later stages, particularly procurement and legal are getting more involved, finance are getting more involved. There are more and more hurdles, and with the onboarding and flicking the switch, as you say, of whatever product or service you're delivering, there are longer delays happening there too. And so what we've seen is that deal slippage from late stage deals has actually quadrupled in the past 24 months. So while going back to the previous point and Gary talking about how important it is for the CFO to have a great relationship with the CRO, you have a situation where a CRO is saying, I'm 90% confident that this pipeline is coming in, or 90% of this pipeline will definitely come in. That CRO is generally correct in that the conversion rate is 90%, but because the slippage has quadrupled, the actual win rate in quarter is more like 60% or just below 60% in the market right now. It seems like it's bouncing back, but that same pattern has emerged in the delivery of services too. So it's essentially that the wild optimism in the market, in the forecasting market right now, is on the timelines over the binary nature of whether a deal will happen. So I would say in terms of assumptions, be a lot more cautious on the timelines, but be more realistic on obviously deals closing and then that they'll happen. And then from that point on, you can monitor it and kind of tweak it from there.
From Gary, from a board perspective, let's say you've built those foundations with the CRO, you've got a great relationship, but this slippage kind of comes into play and forecasts are behind where they're meant to be, even though you've gone about building those pillars. How are you communicating that to the board and the executive team?
In my experience, in terms of forecast to the board, particularly around bookings, and so much of it being back end loaded in the quarter, and Dan's observations and stats are pretty impressive and pretty true, at least based on my experience as well, because so much is back end loaded, and so that slippage causes a big variance in your forecast. I think the first thing is certainly when I'm talking with the board, I give them a range. So here's the range of our forecast. I don't give them a number because there is a lot of variability, particularly in my last company where it was pretty big deals that tended to be pretty binary. And so because of that variance, give them a range and then the top 10. And every board has the time to sit down and listen to the CRO talk about the top 10 and where are they. This is in a board meeting, let's say a month prior to the end of the quarter. I would give them, here's the range. He would go through the top 10 and talk about them in some detail. Here's what stage they're at. Here's, who we've got lined up in order to sign, because it could get down even to logistics of making sure the right person is available to sign because it's between Christmas and New Year's and they're not away on vacation. And so that kind of detail, sharing that with the board, I've always viewed as that transparency helps your credibility. And you're going to miss. Of course, we miss some quarters because things slipped out. But the appreciation of the board understanding what the company is wrestling with and how things can move around helps. It just helps a lot. And as you get, as an organization matures, you get better and better at those probabilities, what's in, what's out, what has a good chance of closing, probably is going to move out to next quarter, all of those sort of gray areas. But I found, certainly sharing with the board, a range. Here's the top deals. Here's where they stand. Here's what we've called in or not called in, so that they have an understanding too of the challenges of just business today.
Yeah, that completely makes sense. Out of curiosity, with the business that you worked in that was more high volume, did you ever come into scenarios where you've got high volume nature of the kind of sales you're getting, but then every now and then there would be significant deals that wouldn't necessarily kind of match the theme of what you'd see typically across your client portfolio? Would you see that, and is that a different conversation that you're having with leadership and with the board, just because of the, I suppose, obscurity of the style of deal that's coming in?
Yeah. I mean, I don't mind speaking directly about the one business that I was in, which was we were a company that sold software to car dealerships. There's like 25,000 car dealerships in the United States. I mean, it's a big customer base that you sell to. But then there are also dealership groups. You've probably heard some of them in the US. AutoNation, for example, they own 200 car dealerships. Like, they're run at like a big corporation. And so a deal with them for all of their dealerships is by definition a big one. We would isolate those because it was a little bit of a barbell, either really big or just, the typical car dealership who owns the Toyota, Ford dealership, and GM dealership in some town in rural Kansas. We would be selling to them as well. That's the more of the transactional, that just by the sheer numbers and the probability, you would get, if you lost one, if you win one, it didn't move the number that much. But those large ones, again, giving them those visibility, and those larger deals by definition obviously take longer, are much more complex. They also matter to the market. If we won that big deal with AutoNation, everyone knows, and that would have a significant market impact. So it was highly visible. And so we would, of course, isolate that and have that much more separate. But the other dealerships, it was a much more sort of continuous flow of business. There was a little bit of, third month of the quarter, waiting, but surprisingly not that much. It was just, you got a fairly significant sales team, all in territories, all selling our software and visiting the 200 or 300 car dealerships in their territory. So it was much more transactional.
Interesting, the key to transparency and put it in front of the board and having to navigate it. Dan, are you seeing that kind of play come up in the market currently?
Absolutely, yeah. So the more uncertainty there is, the more the transparency is required. And so exactly as Gary said, where he said list the top 10, it should be always say, right, where was our pipeline a month ago? Where was our pipeline a quarter ago at the last board meeting? Where did it move to? Where did it slip to? Was it lost? Did the close date change, et cetera, et cetera? And when it comes to communicating those bigger deals, grouping those two is very powerful, because as Gary mentioned, they can actually have more control over the coming quarter of the business if they can see it deal by deal and stakeholder by stakeholder, et cetera.
Brilliant. But when we're talking to people in the market, I think we see some of the challenges around different stakeholders having different definitions of a forecast. So it'd be good to understand, Gary, how you go about defining the different forecasts, calculating and then communicating them internally across the business.
Yeah. So I always like to say, certainly as the CFO of a company, we only have one forecast. There's only one forecast we have as a company. Yes, there are regional forecasts. There might be a country forecast, etc. But but the concept of different forecasts really is just within layers of the company. At my level, at the CRO's level, the CEO's level, there's only one forecast. That's the forecast that the company is giving the board, because I've always worked for PE-backed companies, so it's a private company. Given the board a forecast, that is the number. And I think that mentality does need to make its way down into the organization, down into the sales director. At the rep level, they're trying to make quota, so maybe a little bit different. But in terms of part of the forecasting process, sales directors and above need to understand there is one forecast for the company. All of their inputs result in a range. Then I, as the CFO, typically myself and the CEO, will decide, okay, we're going to build our P&L, meaning our financials forecast, at the low end of the range, at the midpoint of the range. And we tell the board that I've built my financial forecast for the remainder of this year based on the low end of the range that you're seeing in terms of what the CRO is walking you through and showing you. Or no, we feel good about the forecast. We think it's balanced. We're going with the midpoint. That's how we built all of the financials. But that is the one forecast. And certainly for the sales organization, all of their inputs, what they're forecasting, what's in, what's out, is all part of building to that range. But then ultimately, the company just gives, from a financial point of view, one forecast in terms of what do we expect our cash and earnings to be next quarter, the quarter after that, and for the year.
Dan, I'm sure you've got some stories on this point with some of the businesses you've worked at and some of the data you've seen through the platform.
Yeah.
Yeah, absolutely. We've worked with companies backed by Bain, Vista, Charles Bank, and many more, and it's very much in line with what Gary's just said, and that there's a single number that's the number that's submitted, and everyone does it slightly differently. But what's really, really important is that there's a definition of what the number is, what it means, and what the low and high of that range is too. And everyone, as mentioned, has slightly different definitions, but the actual structure is broadly the same across the companies. And it could be that the number is something you're kind of 60 or 65% confident in hitting. There's obviously the upside, and then there's the more conservative one, as Gary said, for managing your cash position, and etc. is down at the more cautious end of the spectrum. But tying this back to when you're talking about managing slippage, etc. If you've got risk of that, you can explain that. Everything should be explained within the range. And when presenting it at the board level or within leadership, explaining the empirical evidence for every assumption, whether it's in quarter and it's based on your existing bookings, your commit pipeline, your best case pipeline, or it's multiple quarters out based on pipeline generation from marketing or any other modeling you've got. If you underpin it with every assumption for each point in the range, then it doesn't have to be front and center, but nonetheless you can fall back on it as discussion points, because people can see what the drivers are. If they disagree with the driver, then you can have that discussion. If they realize that they've got more control over one driver than another, they can invest more money in one part of the business or another. But having that underlying evidence is the common theme of what's the most important.
Brilliant. Thanks so much for that, Dan. And when driving towards an exit eventually, how does the integrity of the revenue forecasting itself affect the ultimate multiple achieved for the business?
Yeah, I think, in terms of looking back at history and looking at forecasting and how accurate is your forecasting, I guess I'd say maybe 2 points on that one, Oliver. One is, I don't think it actually affects or impacts the valuation of your company. I do think, though, that it is what I would call more of a hygiene factor. If you've got a good process in place that is well understood by a third party, a potential acquirer, or a potential investor, and it's resulting in your results being pretty close, or at least you understand when your results come in different than what your forecast. I think that's viewed obviously as a positive amongst other items. How clean are your books? Do you have all your contracts, and are they easy accessible? those kinds of hygienic factors, I'd say, is where I put forecasting. I haven't seen it, certainly in my experience, it resulting in any kind of additional multiple because you're really good at forecasting. I will say, though, the one point that I will say is that your most current forecast, and especially during that time when you're talking to a third party, there's going through due diligence or whatever. Don't miss your forecast. Whatever problems you might have, that's one that is very difficult to understand, to overcome. Is if you've given a forecast and you're in the process of negotiation or you're in the process of due diligence and you miss your forecast. That is one that is that can really impact the possibility or probability of getting the deal done. So in that time period, forecast is really important because they're assessing the integrity, quite frankly, of you, your organization, the sales organization, the finance organization on its ability to deliver. So that would be the one point that I would say, especially during an exit, don't miss your forecast.
Yeah. Dan, what do you tend to see with your clients when it comes to the DD stage and I suppose the state of revenue forecasting?
Yeah, absolutely. And we work with operating partners too, and on the PE side. And I think just looking back at the market, there are some levers for how the private equity fund does the valuation, and it's largely multiple expansion, revenue growth, and margin growth. And now the days of multiple expansion continuing to grow have kind of plateaued or ended. I think there's a bit of a challenge here in that both revenue growth and margin growth are, have asymmetric downside risk, and due to the same reason, whereas private equity wants asymmetric upside risk, and they're going to be sitting there and saying, right, how can I crank the multiple in 5 or 7 years and get my return? And essentially, a lot of CFOs here, so please shout if you disagree, but unexpected expense savings are both rare and small in magnitude. You don't suddenly wrap up the quarter and have millions of dollars in expense savings that you weren't expecting. But unexpected forecast downgrades are common and quite large in magnitude. So both in terms of the revenue growth plan and the margin improvement plan, any volatility there is massively downside rather than upside. And tightening up on the forecast and proving that your historic forecasts over the past 1, 2, or 3 years are accurate and robust can help them to really narrow that down and make sure that you don't get penalized. I think an example of this is Charles Bank have a model for evaluating companies, and they've got 100,000 simulations in Excel, and they put a probability distribution on everything. And essentially, if in their expertise they believe that there's a big risk on something, there'll be a much wider deviation. But if you can prove to them that over recent years you've been submitting numbers and you've been getting great accuracy 1 or 2 sales cycles out, their deviation they'll put into their model, and other funds do this in a similar way, would be much narrower, and then you're much less likely to get penalized. But I completely agree with Gary's point. It doesn't directly drive a much bigger valuation, but in terms of the wider context of the business, it gives a lot more confidence, and it means that deviation gets squeezed right down, the confidence in the business gets higher. So it's definitely helpful, but obviously the primary method would be to actually drive the revenue and drive the EBITDA.
Brilliant. So that's some really great insight there. So thank you, Dan. Now we're going to open the floor to audience questions. So if anyone in the audience does have questions, they can put it into the chat, and we'll have about 10 or so minutes to go through key questions that come up. So I'm just going to wait until these kind of filter through on the chat.
Maybe just while you're waiting for those to come in, maybe I can just make a comment just to build a little bit on Dan's. It was in my article as well. There's just so much stuff going on. There's so many things that come into the inbox of a CFO, and you can sometimes or often get lost in it. And he was talking a little bit about revenue growth and margin. brought to mind my North Star, which is the rule of 40. And so in a classic SaaS software business, whether it's the rule of 40 or 45 or 35, whatever is appropriate for your company, always keeping that sort of just in the back of your mind on any decision that you're making with regards to the business. How do I drive that rule of 40 to 42 to 43? And it's a trade-off. More earnings, more revenue growth. But I find that that's something that I can just kind of fall back on when I'm, sort of indecisive or on the fence, or I'm not sure what I should do. Just I think of that. Okay, well, how will this help or hurt our company in getting to the rule of 40 or 45, whatever our target might be?
Brilliant. Perfect. Thank you for that. And questions I've got come through. So is there a particular piece of software that you would personally recommend for forecasting?
Is that for Dan? Is that for Dan or
Feels like
I think that's for Dan to do a little bit of a commercial, perhaps.
yes, it feels like someone's giving him a softball there.
Absolutely. Look, I mean, there are many valid ways to do forecasting, but as mentioned, Kluster is a forecasting solution offering both software and a services layer, particularly bespoke for private equity-backed businesses. But aside from that, there are many other ways to do this.
Gary, feel free to chip in with it with your experience.
Yeah, I'm sorry to say that I haven't used Kluster Dan's software. I have used one. It's called Clary. It sits on top of Salesforce. And the companies I've worked for have tended to really have Salesforce as the center of operations on all the go-to-market. And so Clary and Salesforce gets confusing very, very quickly, but Clary, I think, sits sort of on top of it. And I found it just, for me, very easy to use, to roll up what's, what opportunities, what's moved, how's the funnel, how's the pipeline changed, all of that kind of information I'd be interested in. So it's one that at least I've had a good experience with.
Cool. I think what we've seen, and this is just from the conversations that I've had with different executives across the B2B SaaS space, is we've seen some investors change their approach to business development within their technology portfolios, going from like a hunter-gatherer approach to a land and expand approach, or vice versa. It would be good to understand, I suppose, Dan, from your side of things, I suppose the data points that you see around those points and how it leads to revenue forecasting accuracy, and also Gary, your take on, I suppose, which is more preferable, or which you've seen personally more success with the sales teams that you've worked with.
Sorry, Oliver, I missed the opening few words of that.
No worries. I was just going to say that we're basically seeing investors change their approach to how their sales teams within their SaaS portfolio businesses will go to market. So either on one side, it being a land and expand approach, or on the other side, a hunter or gather approach. So it'd be good to get, I suppose, the data from your perspective as to what you've seen there and how it ties into revenue forecast. And then from Gary's perspective, getting his side on, I suppose, what he's seen work most effectively, and how he's personally kind of partnered with those teams.
Yeah, I think there has been more of a shift towards efficiency and away from growth at all costs, and that has quite unstable over the past kind of 18 to 24 months. It's really started to stabilize over the past 6 to 9 months, I'd say. And it has led to an increase in the kind of land and expand, as people are looking for really like locking in those bookings and locking in the revenue that they can in each period, and then therefore leading into the forecasting that has really kind of stabilized over the past 6 to 9 months, the assumptions that you can make around the time it takes to close the deal, future upsells and expansion, and churn, which thankfully across the market has started to reduce over the past 9 months too. But Gary, I don't know what you've been seeing.
Yeah, no, I think very much the same from my perspective, Dan. Maybe one sort of nuance in terms of selling into your existing customer base, I do think that there's a fairly significant difference between upselling in terms of expansion, adding more seats, etc., and then cross-sell. If you have a portfolio of products, if you have other products that you can sell into that customer, I've seen that upsell is pretty much like a new sell. It's maybe not quite a new logo, but almost, because you tend to be selling to a different economic buyer, someone else in the organization who would be interested in that software versus the one that you sell to today. And so that land and expand, I think, does have a little bit of nuance to it. Upsell, not that it's easy, but upsell sort of easier as a company grows, as their adoption of your product grows. You'll experience some natural growth there. But if you're trying to cross-sell into a different product, a different tool, a different functionality that has a different economic buyer, that's almost like a new sale. And it has then all the characteristics of it: a longer sales cycle, much more binary in terms of it happening, especially if it's at the end of the quarter, etc. So just a nuance on land and expand versus new logos.
Brilliant. And a good question coming through here. So understanding which software that you use to integrate for revenue recognition. So after the deal is closed, like.
Yeah, can I just jump in there? I'll try not to make this an infomercial, but Gary mentioned Clary before, and they are very much a more near-term sales tool for the tactical sales execution and roll up and integrate with conversation intelligence and all the rest. And Cluster's at the other end of the spectrum of a kind of finance tool and board level tool for longer term forecasting. And we of course manage the roll up process, but on that point about revenue recognition, we've got private equity grade revenue recognition waterfall charts for every possible movement across your revenue stack. So that's where we sit, kind of away from the sales intelligence, right on the edge of the sales intelligence side of the market.
Okay, that makes sense. And I think this is back to the 0.5 that we spoke around the maximizing the deal and getting the multiple on it. So in relation to revenues, organic growth, etc., if it's not sales forecast accuracy, what are the 2 or 3 key items that really boost a multiple in a PE-backed deal?
From again, I'm at the risk of repeating myself, I do think it's that rule of 40. So
okay.
The 2 or 3 key things that every PE firm looks like is your revenue growth in terms of top line growth and your earnings. Those are the 2. I think the other that they look into are, because the PE firms look obviously investing in the company and then taking it to the next level. And what would they need to do? Where would they invest? Where would they focus their operating partners on in order to create value and increase the value of that company? And so there's a lot of focus on unit economics. So for every dollar of additional sales and marketing dollar that I put into the company, because I'm coming in as a new investor, and if I pour money into sales and marketing, or we lend our expertise to help the sales team become more effective and efficient, then what from a unit economics perspective does that result in terms of bottom line contribution? So gross margin is obviously a key one, and then all the other metrics in terms of, you've heard cost to acquire a customer, how much does it cost us to acquire a customer, what is on retention rates, what is the lifetime value? Those kinds of unit economics, I would say, are very, very important, especially for a SaaS software company from a PE firm. So just once again, kind of revenue growth and EBITDA, and then those unit economics from their perspective. If we invest or if we focus in this area, what will result in, I'll borrow one of Dan's words, an asymmetric contribution to the bottom line, and therefore the value of the company.
Brilliant. Love it. Thank you, Gary. So when it comes to trying to convince the board in investing in upgrading tools such as like Salesforce and Kluster, like, is there a typical approach that you would take to I suppose leveraging those relationships in the board and trying to win them over?
Ultimately, and I'd be very interested in Dan's experience on this as well. But boards and investors, they're interested in what's going to help them, and ultimately, therefore, what's going to help in increasing the value of the company. And so, if the investment in a sales tool is going to result in us, and we can show that we're doing it manually now, this system will really help us improve our forecasting so that we can bring you as the board better information. And ultimately, when we sell to a third party, that I think is sort of the angle and the argument that you need to make or present as to why make that investment. Because ultimately, for the board, what will result in added value to them as investors in the company.
Brilliant. Dan, what's your take?
Yeah, absolutely. I just think investing and forecasting is essentially the highest ROI activity you can do, in that you get the edge, and then the upside of that edge is almost infinite rather than having any margins on it. And the B2B sales-led market is essentially the last market out there that doesn't do that. If you look at their examples, the best hedge funds in the world are people with a PhD in maths or physics or something. There are sports teams who invest in mathematicians. Supermarkets invest in teams of data scientists and mathematicians to get the edge. Domino's Pizza invested in a team of mathematicians, and they've outperformed Google, Netflix, Amazon, Facebook over the past 20 years, or similar performance, because they've been optimizing their performance and spending a pretty modest investment relative to the upside in forecasting is just one of the best investments you can make.
Yeah, you've tapped into one of my guilty pleasures there, so I'm going to move on quickly before I pull out the app. One of the good questions we've got here is from a CFO in our community saying, I often find it challenging to forecast services related to software, as the process and timelines can differ significantly. Which systems do you use to monitor and manage these services?
Yeah, so the previous company I worked for was a company called PlanView, which was so I'm doing a bit of a commercial now, which was project management and planning software, and they had a tool called Professional Services Automation. Pretty heavily, it had a lot of integration points into a lot of different systems that you could use for timesheeting, obviously, into the general ledger, et cetera. That's what we used at my past company, and was in fact a product that we sold. So maybe as a bit of a commercial, PlanView, and they have a professional services automation tool that's pretty good.
Dan, thoughts?
Yeah, absolutely. This is one of those challenges that's different per business, but it's essentially zooming out and looking over the past few years of data and looking for trends of, for example, the services as a function of the software spend of each of your customers, different service levels relative to different products, how those service levels link to the initial estimate in the CRM. So what we very often find is that the sales rep is saying, well, we're going to close a deal, and I expect the services revenue in future, once it's closed, to be X per month. It's typically 60 to 70% of what they estimate, but over time it can grow. So essentially run a quick cohort analysis and see how that trends over time, and then how much to scale back the assumption from the sales rep. I'm saying scale back because I've never really seen it being scaled up, but it could be scaled up if they're underestimating too. But yeah, it's different per business, but it's really just looking for those top trends. It's typically 2 or 3 metrics or rules of thumb that really drive the predictability, and then you get diminishing marginal return from trying to use too many metrics and too complex a model. But if you just try and find ratios of spend to other areas of spend and size of company, et cetera, then you can typically get a pretty accurate result.
Brilliant. Another question that we've got from the community is, do you use probability percentages to weigh the sales pipeline, and can you talk us through these?
Dan might have some experience there. I could just talk, briefly about mine. As I mentioned, In my past company, it was a little bit more binary because there were big deals. And so we would basically make the call in terms of including or not including, or the CRO would make that call. We didn't use percentages on those large deals because getting 2/3 of a big deal or missing because you had 2/3 of a big deal in the forecast doesn't really make sense, especially in those larger deals. In the more transactional, we just went off history in terms of we had a lot of reps out there who were doing a lot of these $5,000 add-on, $7,000 add, like really pretty small deals because they're selling to car dealerships. And so we would use just a historical weighting because it was fairly predictable. The trend was fairly steady just on those smaller transaction deals. So that's what we used.
Yeah, absolutely. I think from my perspective, we'd always recommend doing quick probability-based maths and then taking the difference of them instead of having kind of one large black box number. So one example would be take your total pipeline and multiply by the win rate. And then if you have another model where you do the stage-based win rate conversion, so you aggregate by stage and do a sum product based on the stage conversion, when you quickly eyeball the two numbers, you can see if the stage weighted number is higher, it means that your pipeline is skewed towards late stage deals. So you might have a great quarter now and a worse quarter next quarter, and vice versa. And another way of looking at the probabilities, as kind of mentioned before, people are really aggressively optimistic on timelines. They're a lot more realistic on whether or not a deal will close. So really double checking your maths on the probability of it closing within a certain period, and then maybe pushing the pipeline to subsequent periods, and really making sure that you focus on the estimation of the close date more than any assumption of whether the deal will close, because that is, everyone likes to be optimistic, but whether or not a deal will close is a lot more accurate generally than the timeline. So I'd say make sure to include that in your probabilistic approach.
Perfect. And again, it sounds like a bit of a softball for Dan, this one. How long does it take to integrate Kluster into an existing ERP, and how long does it take for the tool to provide accurate forecasting data?
Yeah, so essentially Kluster's out of the box. We deliver a proof of value without signing up, which is cost free. As long as we've got a slot on our calendar, but essentially we can be up and running within days or a week, and the forecast is as accurate as the data. So if you've had your CRM and your ERP for 10 years, then from day one it's just as accurate as it will ever be.
Perfect. Well, I'd like to thank you both for taking the time to jump on and share some great insight with the community. As I said, we've had 100 different operators across 3 different continents. So it's been great to share insight from both of you with our wider CFO community, and generally really enjoyed the conversation. So thank you so much. Thank you to the audience and the community for joining. And yeah, hope everyone has a lovely evening. And yeah, if there's anything else either of you want to add before parting comments, feel free to.